Good afternoon, everyone, and thank you for joining us. My name is John Lancaster, and I'm the partner in charge of our construction department here at Forty Brown. The construction industry is one of our largest industry groups here at Forty Brown, and we specialize in the audit, review, tax, and accounting services of any type of trade and any type of contractor. I am also a CCIFP, which is a Certified Construction Industry Financial Professional. We have several of CCIFPs on staff here at Forty Brown, and that just shows, our expertise within the construction accounting department. We all know that construction has its own set of complexities, several of which we're going to be going over through this presentation. I have here with me Bo, who is a supervisor here in our audit and review department at Forty Brown. Bo handles many of our construction contractor clients, and he is going to be going over building financial foundations, accounting best practices for contractors. Now, during the duration of this presentation, I encourage you all to submit any questions, inquiries using the Q&A box. We are going to leave time at the end of Bo's presentation to address any questions you may have, and we'll also follow up with any that we may not be able to address at this time. And with that being said, I'm going to turn it over here to Bo.
Thank you, John. As John mentioned, I'm a supervisor here at Forty Brown and dealing a lot of work with our construction department. Today we'll be going over a few items within the make up the best practices that we see for some of our contractors. On our agenda today is our, we'll go over financial statement considerations, financial statement presentation and disclosures unique to the construction industry, some of the basics of WIP accounting, because it is one of the more complex accounting structures within our industry, and then some gain fade analysis with at the job and contractor level, and then some WIP scenario analysis you'll see as well. And then, as John mentioned at the end as well, we'll have some time to go over questions and comments that you guys submit throughout the presentation. So starting with financial statement presentation, we'll start with the balance sheet. And as those of you know from your accounting classes way long ago, the balance sheet is the point in time presentation of the health of the business. It's involved in many key ratios that are significantly reviewed by third parties such as bankers, surety and insurance professionals as well. And there are some unique balance sheet terminologies and unique balance sheet accounts to the construction industry. The first one being contract receivables. This in itself is not that different from account receivables that you see on manufacturers or other industries. However, it's the other unique portion of the receivable side for contractors is retention. This is the portion of the contract payment that is withheld from until the project is substantially complete. It's typically 5 to 10% of the contract. It depends on the industry or the type of contract it is. I know a lot of our clients, 10% is usually the standard that we see. Inventory isn't something that typically is booked on a lot of our contractors, but as a consideration, we always like to look into if, there's a lot of materials on a job, especially a job that covers a few year period. Some of the longest balance sheet accounts that you'll ever see reading a financial statement would be costs and estimated earnings in excess of billings on uncompleted contracts, and then the liability side, billings in excess of costs and estimated earnings on uncompleted contracts. I dare you all to say that 5 times fast tonight when you're looking back at this presentation. But the gist of those two is to true up timings of billings and the revenue recognition. You'll never see these two accounts netted together. There's always going to be an asset, costs and estimated earnings, and always going to be a liability of billings in excess of costs, and we will dive into that a little bit more later as well. So we talked about the balance sheet. On the flip side of the financial statement presentation, we also have the income statement, which contracts, manufacturers, the terminology is relatively similar. Contractors have contract revenue earned, similar to a manufacturer. Instead of, sales, you see contract revenue. And in turn, we also have cost of revenue earned instead of cost of goods sold that you may see from a manufacturer or other for-profit businesses. G&A expenses, general administrative, we see across the board as well. No difference there across industries. And then other income and expenses, this is those extraordinary one-time items with the high interest rates. In the last few years, interest income and expenses fall in this bucket. Fixed asset sales, stuff like that. Cash flows, the statement of cash flows, no significant differences for any terminology or usage across industries. So on the financial statement disclosures for an audited or reviewed financial statement that we do, we'll have footnotes attached to them. And you'll see here an example of a contract receivable footnote. You'll notice it doesn't include retention because retention is, as I mentioned previously, broken out separately from accounts receivable. So within the footnotes, we break down the aging and breaking it down to see how much of the revenue that has been recognized or revenue or receivable that's still out there is current versus how much of it is looking too old. Contractors generally can sometimes have contracts that span over a few years or a long time period. It's important to constantly review old accounts receivable for any disputes, potential non-payment. And then we also like to show out, in relation to the non-payment, allowance for any credit losses. It's a bit out of the scope of our presentation here, but it's provides more timely recognition of what potential credit loss could be. Forever you've heard it called allowance for bad debt, but a few years ago this was changed to allowance for credit losses or credit loss expense. It requires a little more estimation on how much of our accounts receivable is truly collectible, but just another resource that we have to be able to visually see what's coming in. More on the financial statement disclosures. Organizations, companies, contractors are required to disclose information about uncompleted contracts, and on an audited and review financial statements, we disclose this information. So these two examples of footnotes are reconciling our over and under billings that I had talked about on the balance sheet together, and showing what the costs incurred on any uncompleted contracts are to the revenue incurred on any uncompleted contracts to see, is the organization overbilling for cost for work to be done or underbilling for work to be done as well. So this is another disclosure, and these are two examples of the two different footnotes that we have that coincide with our balance sheet presentation. And here on this next slide is a full example of what a contractor balance sheet will look like. The one distinction I'll point out here is this is a single year financial statement. We prepare audited and reviewed financial statements that are comparative as well. It's really truly up to what the company is is looking for and how they would like their financial statements prepared. Some key highlights: the contract receivables net is net of that credit loss that you saw a few slides ago on the financial statement disclosures within the footnotes. And then that retainage receivable line is, as I mentioned, separately stated from contract receivables, which is something that was changed a few years ago as well to provide more information to the reader of the financial statement or the user of the financial statements. You'll see the costs and estimated earnings in excess of billings is an asset account as well. And we will go into more detail on this on the work in process slides later in the presentation. And just remember that this is a mechanism to account for differences in the timing and billing of any revenue recognition. At the bottom in the other assets portion of the balance sheet, these are examples of what we typically see on a contractor's balance sheet. Deposits might be a security deposit on their lease, and then the operating lease right of use assets. This is a bit out of the scope of our presentation, but was another accounting change implemented a couple of years ago now, that many contractors have, whether it be the building that they lease or any equipment that they lease for work, or such as vehicles, equipment to use on the job. So that's another thing that we've talked to our contractors about and updated. Whenever they get a new lease, it's something that we have to disclose on the financial statements. On the flip side of that same coin, at the bottom of the balance sheet would be the liabilities and stockholders' equity, and this is another example of what we typically see on a contractor's financial statement. Some of the key differences you would see separately from across the industry is the billings in excess of costs and estimated earnings. As I mentioned previously on the cost in excess, we'll go into this more detail in a few slides. And this is the opposite side of that same coin for the costs in excess being on the liability. We typically see this if contractors have build more revenue or build for more work than they've completed. Then on the flip side, the underbilling or the cost in excess, they've done more work than they've billed for. I talked about the right of use asset a minute ago. In the long-term obligations, this operating lease liabilities is the liability side of those leases that a company may have, whether it be a office lease, equipment lease, vehicle lease, what have you. They all fall into that bucket. And then here's a quick example of an illustration of what a condensed statement of income looks like for a lot of our contractors. The contract revenue earned, and then the cost of contract revenue earned as well. The two big things to look at that we look at for general administrative expenses. We have some contractors we provide audited or reviewed financial statements for. We provide a schedule breaking that out to show so that they can see what some of their overhead accounts are and what their G&A expenses are, and provide a little bit more detail to the reader. And those other income, extraordinary, sometimes one-time items are broken out in there in a little bit more detail on the schedule below, such as the gain on sale of fixed assets, interest, or miscellaneous income. We saw that a lot with those employee retention credits a few years ago, or the PPP loans. You'll remember all that from back during 2020 and 2021. So, and here's a example of a statement of cash flows. The operating activities is pretty consistent across the board between industries, going through the changes year over year in the balance sheet accounts. On some of the one-off activities that we see on the investing activities portion of the statement of cash flows, This is where we would document purchase and sale of fixed assets, or purchase of, if they have an investment account, investment portfolio, purchase of stocks, or any sort of security the organization might purchase. Then financing activities, we commonly see, you'll see that down there towards the bottom. If the owners take any distributions for the year, you'll see that in this bucket here on the statement of cash flows. Any repayment or draw on the line of credit is documented within this bucket, as well as the statement of cash flow, or any repayment of loans that an organization or company might have, such as equipment loans like excavators or any sort of equipment used on the job. So a quick overview on the financial statement considerations. I talked a lot about audited and reviewed financial statements already. Like, why would a construction company need an auditor review? One might be bank compliance, if there's any sort of line of credit, to assess the credit worthiness of the company before extending a loan or any credit lines, and the bank wants to ensure they're getting accurate information that's been reviewed by a third party and had an opinion expressed on. Why would a contractor need a line of credit? Even the healthiest balance sheet, healthiest business, and most profitable contractor still utilizes their line of credit. The construction industry can be very cyclical, especially in a climate like the state of Illinois, like we're in, where the winter can put a pause on some construction jobs, and this can affect the cash flow of the organization, in which they might need, even with a healthy balance sheet, they may need to tap into a line of credit to be able to utilize funds during those slower months. And it's important in these instances to be, conservative with cash and project out your cash flow and utilize some of these key ratios that I'll explain towards the end of the presentation to ensure that all money and resources aren't tied up in jobs that may take a while, that will eventually be profitable, but prevent the organization and the company from pursuing other jobs. Bonding requirements. Surety companies also might require an audited financial statement to issue any bonds to the company, and then an audited financial statement helps provide them with assurances that there's stability within the contractor. And then contract requirements or pre-qualification. Think government projects, Illinois Department of Transportation, or any Department of Transportation for that matter, sometimes require audited financial statements for the pre-qualification process to be able to bid on those jobs and ultimately get those jobs. And then another benefit is management and investor analysis. An auditor review provides the management of the company or the investors of the company assessment that what they're doing is working, the company is in a strong financial position, or helps provide them with a third party's opinion on some stuff needs to be changed, and it can help ensure transparency within the organization and accountability. So, work in process schedules. As I mentioned earlier, we're going to go over some of the basics as well as some scenario analysis within a WIP schedule. The construction company or construction financial statements is a little bit unique in that the financial statements are based on management's projections of contract revenue and contract costs. And projections is the key word here, hence why we have it outlined. A WIP schedule is only as good as the data input into it, and proper estimates are key, as well as keeping up with things like change orders. Without this estimation, that's the proper estimation. The WIP schedule can't give you a true financial picture, which if we can't see the true financial picture, the users can't see the true financial picture, we can't give proper analysis to be able to do our jobs. Some of the basics of how a WIP schedule works is on the percentage. It's based on the percentage of completion method, which is essentially the premise that revenue is earned and recognized as the project is completed. So with this being said, the costs, not the billings, are what drive the revenue recognition within a WIP schedule, which is an extremely key distinction and unique to the construction industry and not something you'll see in any other industry. And this can be one of the number one misunderstandings that people have when reviewing a WIP schedule. So these three formulas we have are some of the three that make up are the drivers of a WIP schedule. The first line item is the item that essentially drives everything, is the cost to date, the costs incurred on that job. So those costs to date give us, divided by our total contract costs that are estimated, give us the percentage complete of the job. And ultimately, this percentage complete multiplied by what our estimated contract amount is our revenue earned for the organization, or in turn gives us our contract revenue. And then that over under billings that I had, that we've been talking about on the balance sheet, the revenue earned less billings gives us our over under billings. And you might have the question, is it better to be overbilled or underbilled? That's kind of a twofold answer, but overbilled means that you have been billing for more work than you've completed. While this might sound like a good thing, it's important for the company to know that they're actually overbilled at the moment and they don't spend those funds elsewhere, because things happen. You don't want to overextend yourself, and if a job pauses, doesn't get complete for whatever reason, those funds truly aren't earned anymore. And if you haven't made the money, you don't want to spend them in other places until that money's truly been made. So next up, we'll go over an example of what a simple WIP schedule might look like. As you can see, this WIP schedule provides an insight to each committed job that's still in process. That's the important distinction. The work in process schedule doesn't show any completed jobs. As you can see in this example, the percentage complete in the middle doesn't show any 100% complete jobs. We have a wide range here from 5% complete to 80% complete. And you can almost look at this schedule in two different parts, which we'll break down each part in more detail coming up. But we also have a large variety in this example of jobs that have high gross profit, low gross profit, and some over and under billings as well. So while this WIP schedule, the usage of it allows the users, whether that be management, the bankers, outside people, to spot trends that may need to be addressed within each job or within the open jobs as a whole before it's complete. So as complex as the schedule may look, there is really only 4 inputs on the simple WIP schedule that we truly need to make. The rest are all formula driven. The breakdown, everything in black is something that we input into the WIP schedule, and then the red items are all driven by formulas. On the left side, we have our total estimated contracts, our estimated contract revenue, and estimated contract costs that we enter in. This is the most important part of the WIP schedule. Without good estimates, we can't see the full financial picture, and you'll see some of that in our scenario analysis coming up shortly. And then on the contract to date side, we have our input of contract costs and progress billings. There is no subjectivity to these two entries. These are pulled directly from the accounting system utilized. The one thing that's always important is to pull this information from the correct date you're looking at. So whether that be, an end of a quarter, end of a month, annually, the correct date is important to get. Otherwise, for the data pulled from the system, if it's not the right date, it's tough for us to use and tough for the user to use. So, total estimated contracts. This is been emphasized a few times lately, but this is the most important part of the WIP schedule and the part where the non-accountants and the accountants have to be able to communicate and communicate effectively. And then the WIP schedule, I know I sound like a broken record, but is only as good as its estimates. While an estimate is in nature, will never be inherently perfect. Some of the best contractors that we work with are able to accurately predict the outcome of a job from the beginning. And that's something that comes with them, doing the job for a long time and working in the industry they have for a long time. But that accuracy, that communication that they have with the accountants leads them to be able to have accurate and strong financial information. And then another thing I wanted to comment on is lost jobs. While I don't show an example of a lost job here, GAAP requires that if it becomes probable that a loss on a job is to occur, the loss has to be recognized immediately, which is different from what I've been talking about so far in the contract. Profitable contracts recognized over time. Essentially being that GAAP is saying losses can't be recognized over the life of the contract. This isn't something that we see too often, frankly, because if a contractor is losing jobs and having lost jobs, they won't stay in business that long, because they're losing money consistently. And it's also something too that management is, generally most management when they start a job are optimistic of the profitability of the job, and you're not estimating on the outset that a job's going to end in a loss. And you likely don't realize that it's something that went bad. Something went bad or a loss is to occur until much later. For example, we wouldn't see this on a job that's 5 to 10% complete, generally. Okay. Contract to date, actual contracts, costs, and billings. Mentioned earlier in the full picture scenario, the WIP schedule, there's not a ton of subjectivity to these line items. Contract costs, progress billings, pulled directly from the accounting system. This contract's had this many costs, this much cost, this much billings to date. The numbers are what the numbers are. And then everything else is fairly formula driven in the contract revenue column. The costs in the contract costs drives that revenue column, and same with the gross profit and the over and under billing that ultimately goes to the balance sheet asset and balance sheet liability account, which you can see at the bottom of that schedule. The 106,500 and the 255,000 eventually flow to the balance sheet. And then let's also discuss future workload or backlog, which is another important indicator of financial health that is presented on a WIP schedule. Um, because a healthy backlog ensures a steady stream of future revenue. Because while, a lot of accounting can be look back on stuff that's already occurred, most management and, you know, bankers and others, readers of the financial statement want to see what's the future going to look like. What are the future jobs that are the future work that's going into the pipeline? Um, and it also helps with risk management for management as well. A managed backlog helps identify potential risks to the that the company could be in, such as, overcommitting to projects or if they have a big backlog with a large project still in process, or, underestimating the resources needed to complete a job can be shown within the backlog. This is also some strategic planning involved here too as well. This can give management an idea of whether to bid on new projects, or if their backlog is just too large, maybe they need to focus on completing existing ones. Uh, Backlog is something that we disclose on our financial statements because it's a key piece of info to the users. However, as you can see in that one excerpt or example of a footnote, it's an unaudited section because it's looking at work to be completed in the future, and we don't do any testing as part of an auditor review on future contracts as part of our current audit procedures. But the quick formulas for backlog and cost to complete, you can see up there. It's just estimated contract revenue less the contract revenue earned to date, and then cost to complete, total estimated costs less total costs incurred. So we just went over some simple WIP schedule examples, but what are some things that we typically see that are common errors? Because as accountants and auditors, we do see errors on these schedules. Some of the big ones are, actual costs that are in excess of total estimated costs. You'll see in this is the same WIP schedule just from previously, just with a few minor tweaks. In Contract 101, the contract costs is now 225,000, and our job complete percentage is 150%. How can this be? We can't have a job be over 100% complete. When we see something like this, it's, likely a change order may not have been communicated from the non-accountants to the accountants. Hence why communication is so key, because you can see, like, we see this is a fairly common thing that we see where these costs aren't properly allocated, a change order wasn't discussed, and all of a sudden it's changed what our contract revenue was, what our gross profit was going to be on the job, and what our backlog was going to be. Another thing that we might see is the contract to date for the contract costs and progress billings isn't the correct date. I know I talked about this earlier, but sometimes the cost reports or billing reports might not be the correct date and as what we're looking for, and even one day off of data isn't a usable report. So it's something that's really important to be able to work with our contractors and work with people to be able to get this accurate information, and work with the project managers to be able to, if a change order comes in, make sure the accountants know that change order sooner rather than later. And one suggestion that I always give people is to, run check formulas in Excel when you export your WIP schedule and see like, oh, is my WIP schedule 100 over 100% complete? That should trigger something right there that, oh, I might have an error within my schedule and have to look into it further. So, here's just a look back at for your reference as to what our WIP schedule looks like, what our simple WIP schedule looked like originally. This is it back to the original sample schedule, and the original sample, because next we'll be going over some of our scenarios in which some things change, and you'll see what exactly that change does to our WIP schedule and ultimately our revenue and other accounts as well. So in this scenario, job 102, we increased estimated costs by 349,820. Maybe a large change order came in and this job was going to cost a lot more than what we originally estimated for. Excuse me. This increase in total estimated cost dropped our revenue by almost 323,000 because, as you recall, our contract revenue is ultimately driven by our costs and estimated costs. And you'll see that the job that was 60% complete is now 27.7% complete, because the estimated cost has gone up a lot and the cost to date hasn't changed. We can't recognize as much of the revenue that the contract is supposed to bring in. And now as a result, our gross profit percentage and gross profit is much lower. This would be an example of a profit fade, which I will discuss in a few slides. So a little bit of a teaser. And then now we have our second scenario. So job 102, is back to our original schedule of the cost being 300,000. But in this example, we increase the contract value of job 101 by 150,000. And this increased in turn our revenue by 120,000. You'll notice the job completion percentage hasn't changed. It's still 80% because that's all driven from estimated costs and costs incurred to date. So that total hasn't changed. But our gross profit percentage and gross profit has changed. Our gross profit went up from 40,000 in the original scenario to 160,000. And that increased our gross profit percentage from 25% to almost 60%. And then this would be an example of a profit gain, which I'll explain in a few slides. And you'll also see this increased our over/under billings by 120,000 as well. So it does have an effect on the balance sheet, just by this one change to one contract. So to kind of wrap everything we just went over up a little bit, scenario analysis is an important part of the construction industry, and it's super important to make sure that everyone is on the same page. I just want to keep reiterating that because it does truly affect the financial statements that the company has. And it's important, to discuss what costs are being included within these WIP schedule. Are the direct costs and indirect costs properly accounted for? Direct costs, pretty straightforward concept. It's the cost related to that job, materials, subcontractor expense, directly accounted for within that job. Indirect costs can be a little bit trickier to account for because they're generally not attributable to specific projects. They have, you get payroll burden, payroll taxes associated with labor, or administrative salaries of staff uh, who are supporting these projects. So it's super important to have these conversations with between management, project managers, internal accountants, external accountants, as well. It's something that we can help provide and help, advise our clients on as well. So you've heard me talk a couple of times about a profit gain and a profit fade. Uh, so what is it? It's one of our best tools that we utilize to help our clients estimate or assess how good their estimates are. And it's essentially a trend analysis of the estimated or actual gross profit of the projects they have in progress that go over reporting periods. Because as many of you know, jobs start and end in different periods. Some jobs span a few years, some jobs overlap years, and it's not very common where jobs start and end within 1 year, or all of a company's jobs start within 1 year. So if an actual gross profit is greater than the estimated gross profit that we estimated a year ago when reviewing, or a quarter ago, depending on the periods you're reviewing, it'd be a profit gain. If the actual gross profit is less than the estimated, it'd be the inverse, a profit fade. So a couple of reasons that there might be a profit fade. An estimator might be too optimistic on his estimates. Performance of the job just wasn't so good. Sometimes that things happen on the job, and where it wasn't as profitable. It wasn't profitable that compared to what we thought it was going to be a year ago when we reviewed this. And then it could be the particular project or that the organization took on was outside the scope of the work of the construction company. That also happens as well. And then it could also happen for another reason. Costs could be posted to the incorrect job. We do see this sometimes where a cost was put in the wrong spot, or non-job costs being run through some jobs to accelerate revenue recognition. This is a good tool for us to be able to, inquire and see, like, does this really make sense, all these costs being incurred. It's also a good way for us when we're auditing a company to detect if there's been any fraud via cost shifting, which would be essentially shifting costs from one job to another to help some jobs remain profitable. For example, it's if it may indicate, for example, if one job was showing a $50,000 profit and is now an $80,000 profit, and another job drops, it could indicate that something doesn't quite add up. And this gain fade analysis is something that we can utilize to see those anomalies. And generally speaking, we want to see profit gains over profit fades because it shows management's conservative in their estimates and isn't generally being overly aggressive. So within this example here, you'll see we looked at 2024 contracts and 2025 contracts for two different periods for 4 jobs. You'll notice job 105 isn't included here. These are the same jobs from the WIP example I was showing earlier, because that job had started in 2025. So this profit gain fade analysis only We only review jobs that cover multiple periods. And you'll see two highlighted at the end where a gain fade, there was a fade of 31,000 for job 101 and a gain of 111,000 for 101. Typically, we as auditors usually have a conversation with our clients if there is a gain or a fade over 10% and the gain reaches a gain or fade changes a material amount, and that's over our testing scope, which is different between every client we work with, depending on the size of the client. So it usually triggers a conversation with them and us saying, what happened? What happened on this job to make it go up or down? And they usually have an explanation. Almost always have an explanation as to how things changed. So continuing on about profit gain fades, it's important to examine the subsequent activity on a job whenever possible, excuse me. And as I mentioned, it's a tool to discuss things with management. Those two jobs is something that if I were auditing this client, I would definitely reach out to their accountant, or controller, CFO, or owner, see what happened with those jobs. It also helps us identify any red flags, such as underestimated costs, poor performance, or just, sometimes bad change orders. And then, as I mentioned before, it's a red flag for underestimating cost to artificially keep profits lower as well. Is another thing that we can see utilizing this tool, and is a tool that that companies can use as well to help identify any changes over jobs. So some management discussion points that we typically like to talk to with some of our contractors that we work with is, help making sure they understand and utilize the proper reports, projections, and how we can help with that. And looking at their WIP schedules and saying, is a job night, if a job's getting close to being completed, for example, if it shows 90% complete, we'll talk to the client and see, is this job actually complete, or is it almost complete, to make sure that the WIP schedule is truly accurate, because that's also a way we can find some changes in the WIP schedule. And it's important to remember that sometimes on a WIP schedule that the percentage complete is generally really what is financially complete on the job, which is often a little bit less than what physically complete means, just due to some time lags between the project and when the financial transactions take place. And that's something to also document and also note when talking with contractors and management, because if a project appears to be more financially complete than physically complete, there's a chance that there could be, cost overruns or profit fades, which is something that we want to discuss with our client about, and that if management notices that themselves, should have an internal discussion as well. Continuing on with management discussion points, it's also important to talk about jobs that are unusually high or low profit margins compared to what the average is. If I have a contractor that typically, they almost always have jobs that end between their gross profit percentage is 15 to 30% or 15 to 25%. All of a sudden they have a job that showing 70% gross profit percentage. What happened there? Why did that one shoot up so much? Or if there's only going to be a 2% gross profit percentage, what happened with that job? And discussing those things early is important talk with management. And then I talked about this a little bit already, but the expected lost jobs, identifying earlier rather than later is important as well, because the lost contracts are recognized immediately when it becomes evident that they're going to occur. Obviously, we're not gonna see that on a job that's 2% complete, but a job that's 40 to 50% complete, it's pretty evident that they're going to have a loss on it just looking at the costs and the estimated revenue. That's when it's important to identify those before it gets too far down the line. And then significantly over under billings. This is important to help plan for cash flow and plan for how the organization is going to utilize funding moving forward to get through the next few jobs, and maybe utilize those line of credits, or any other ways they can get creative with their cash flow. And then continuing on with management discussion points as well, we also love to talk about key ratios, and I know other users of the financial statements look at these a lot as well, whether bankers with loans, buying and selling businesses. These ones are key that purchasers and sellers look at. The current ratio, current assets over current liabilities, shows the liquidity of if all the company's liabilities were to come due at a given time. Could they pay those back and still be in a good position? Working capital, it helps indicate the resources that are available for management, operations, and new projects. A positive working capital helps the company show that they can handle any unexpected costs or delays without any jeopardizing other jobs, because that does happen. Days of cash, this is important, because it can give us the length that a company can operate with if no new revenue, no new cash came in, which is something to look at with how cyclical, in up and down nature that construction industry can have. The gross profit margin reflects the job profitability before any overhead and can help signal that there might be estimating issues if it's too low, cost overruns, or maybe overly aggressive bidding, which can be key risks for contractors. And then net profit margin. This shows the overall profitability after all the expenses and can help clients understand if there's any overhead or indirect costs that they might need to control a little bit. The overall benefits of looking at these ratios is it helps give financial awareness to management, the contractor, or anyone outside of the business to see truly what the health of the business is looking like and overall trends, which can also help, support decision making, strengthen relationships with lenders or bonding companies because they use these a lot, and then also provide as an early warning system if, something is about to go awry.
All right, great job, Bo. We have seen quite a few questions come through to me, so I've just been kind of going through those as you've been presenting, Bo.
Sure.
I think I'll cover the first one, to let you take a little break.
Thanks, John.
The biggest issue? What is the biggest issue or error you see when reviewing work in process schedules? I think this question came through prior to your slide, Bo, but I think it's worth revisiting because we do have it where when we're reviewing client work in process schedules, we see that the billed amounts for the work in process schedules significantly exceed the contract values, or the total incurred costs significantly exceed the total estimated costs. And both of those are technically mathematically impossible, but it happens, more often than you may think. Another big one too is simple. It's clerical errors. I think that we see there's a lot of formulas that can be overridden in, if let's say if it's an Excel-based work in process schedule, or even if you have a very robust construction accounting software and a WIP interface, a lot of times those formulas and those inputs can be overridden. And if they're overridden, there could be a significant impact on the over and under billing calculation of the company. So always worth the review and make sure that everything makes sense when you're preparing these work in process schedules. The second I wanted to cover as well, because this came through in a few different ways, it's how often should a company prepare a work in process schedule? And that's something where there's not necessarily a one size fits all. What works for one company may not work for another. If you're a company that requires an audited, reviewed, or a GAAP financial statement where you need to have that work in process calculation, at minimum, you need to do it annually. Where we see it best practice amongst the industry is our contractor clients are preparing the work in process schedules quarterly, because we all know how big some of these contracts can be and how much profitability can change within these contracts. So by having that quarterly close and that quarterly work in process accounting and work in process adjustments is going to help management better manage their company, as well as the profitability of those particular contracts. We do see it where there's quite a few clients that prepare it monthly as well. And it all just depends on, you know, your close procedures and what you're going for with regards to the work in process accounting. Bo, I'll let you handle this one with change orders. It says, with regard to change orders, how are they accounted for, or what processes should be in place to ensure that change orders are accurately captured in the WIP schedules?
So I think this comes down to clear communication between the accountants and project managers. I also think it's incredibly important to have standardized documentation when it comes to change orders, you know, documenting that it's been communicated to the accountant, because the organization's WIP schedule is ultimately only as good as the information it's given, and failure to capture those change orders can lead to inaccuracies. And you know, it's the internal controls should be in place to ensure that the organization and the company has, you know, accurate data, accurate financial statement, financial information. So standardized documentation, clear communication between project managers, and reconciliation of what the project manager is showing, budgets, to what the WIP schedule is showing, because that can help identify these inaccuracies early.
Okay, great. One question on backlog. So on a slide, you mentioned backlog is disclosed as unaudited. How do you validate the accuracy of backlog figures, and what assurance can you provide that these revenues are realistic?
So it's more of a disclosure that provides, you know, what the expected revenue is for the future. It kind of gives an indicator of the financial health of the organization, and, you know, helps plan for resources. And we mark it unaudited because it's something, since it's a future use and a future revenue coming down the pipeline, obviously it can always change a little bit, and we can't ultimately issue an audit opinion on those on the backlog, hence why we document that it's unaudited. But it helps aid management in strategic decision making, you know, risk management, and external users can utilize it to verify that the company's pipeline has jobs coming in and there's earning potential there. So they're not lending funds to a company that doesn't have jobs coming down the line.
All right, great. We'll do one more question as we get to our time. What steps can we take to reduce the risk of profit gains or fades on long-term projects? So I'd say focus on the fades in this case.
Yeah, so I think you know, reviewing the WIP schedule on a more regular basis, then that can help tighten control over and mitigate any issues that the company might be seeing, and you know, do individual job cost tracking. Uh, when we generally on an annual basis prepare a financial statement for an organization, we have our WIP schedule attached to it. The company can then utilize the cost tracking of the job and see, you know, are these costs following what our estimated cost was on the WIP schedule? Uh, and a good way to control that is, tighter control on change orders. I know change orders happen and stuff changes by jobs, and then do an analysis by job phase as the job keeps moving. Keep looking at it and seeing if things are progressing the way you think they should be.
Okay, great. All right, well, thank you everyone for attending, and thank you, Bo, for your insight on the work in process schedules. For those questions that we didn't get to, or if you think of any further questions, I encourage you to use that Q&A function that we have in this interface, and we'll follow up with those that come through. Thanks again for attending, and if there's any other topics you want our team to cover in the future, please let us know. Thanks, everyone.
Thank you, everybody.